What is the SEC and what do they care about? Why is it such a thorn in the side of so many companies in the Web3 space? What is a security?
The only thing you need to know if you're starting a project or a company or anything in this space is get a lawyer.
Hello and welcome everybody to the Rising Up podcast by Faceless Labs. I am your host. My name is Mack, aka the Oracle. I'm joined by my co-founder and good friend, Alex, aka the Heliomancer. And today we are welcoming a very special guest, Andrew Bull of Bull Blockchain Law. If you haven't heard of the Rising Up podcast, this is the official podcast of the financial revolution. We're going to take you behind the scenes of our company's story and give you an inside look at the wild and wonderful world of cryptocurrency. It's not just a show for techies and investors. We're going to introduce you to our community members, our friends in the space, and the movers and shakers of Web3 to make you feel like you're right here with us building the future. Shout out to editing, am I right?
Yes.
So everything we do is about helping regular people leverage the power of blockchain technology to rise up and rewrite their financial future. So without further ado, Andrew, welcome, my friend.
Thanks for having me. I really appreciate it, guys. Yeah. Happy to be here.
So for some backstory, Andrew was referred to us. When did we start talking? Back in pretty early on, January?
It's been a while.
December?
Yeah. I think it was like maybe late 2021.
Yeah, it was. But I think it was before things really got going. And to say to say late last year, it doesn't sound that long ago, but in crypto, it's like dog years. So I feel like we've known you for like 7 years at least.
That's what it feels like.
Yeah, and
sure.
we've been through a lot. We've asked your opinion on many a legal issue, and as time has gone on, we've really come to trust your legal counsel. So we want to thank you for being with us. And, a good reason to bring you onto the podcast is to answer a lot of questions that people probably have, to kind of go over some of the things that people miss and kind of, explain a little bit why the legal aspect was so important in our thinking when we were creating this project, because Alex and I have always had a long-term vision for sustainability and success. And we feel like a lot of projects, whether they be crypto or NFT projects, kind of miss out. And we're kind of expecting the SEC to come in and just rug pull, at least half of them. So I guess the first question would be, what is the SEC and what do they care about? Why is it such a thorn in the side of so many companies in the Web3 space?
Yeah, absolutely. It's a great question. And it's honestly important for every single person operating in the space to understand what their role is and why they exist. So the Securities Exchange Commission is essentially a consumer protection focused federal governmental agency here in the United States. And they're tasked with regulatory oversight, and they have an administrative function, which basically means that they can go in and subpoena information from prospective companies that they deem that are potentially problematic from a consumer protection standpoint. And then they obviously carry out some type of enforcement in the context of subpoenaing information, reviewing it, and then starting administrative proceedings that would ultimately potentially lead to a fine or some more egregious penalty towards the company or founders or something along those lines. So that's their main oversight. And again, the SEC has existed for a very long time and really kind of been a financial watchdog, for lack of a better term. But in the crypto and NFT context, because we have such a nascent technology that has now birthed these different types of assets that exist, one of the kind of issues that we have is a disconnect in terms of the SEC's understanding of the industry. And kind of going back in the historical backdrop of this industry as well, they started really getting heavily involved during the ICO boom in 2017, eventually categorizing certain tokens as securities. And so there's now kind of a litmus test that the SEC uses when they're evaluating companies within this space to determine whether they're problematic. I will say that they very much heavily focus on bad faith actors in the industry. So they're really trying to target scams, fraudsters, phishing scams as well. But at the same time, there's still companies that obviously thought they were doing certain things legitimately that have also come under fire. And obviously, the most notorious ongoing case currently is Ripple and the XRP token. And the SEC has obviously been in a legal battle with them for over a year and a half.
XRP v SEC is a pretty iconic one. And whether or not you like Ripple, I think anyone in the crypto space should be rooting for Ripple because it can kind of open up the floodgates for the rest of them. So,
right. And to that point, just one quick anecdote, because it does look like Ripple is winning the battle from a legal standpoint, from my perspective, for sure. They've won a lot of motions, and they're ultimately, a lot of times, these scenarios, they typically end in settlement of the company agreeing to a fine and then agreeing that they're going to comply. And Ripple
right.
from the get-go has obviously taken the opposite strategy and been very much, hey, we're going to fight this legally. Like, we're really trying to get a positive outcome for the industry as well. And so it's funneling in that trajectory, but obviously it's still unknown what could happen. Yeah.
In a base sense, then, can you say what the SEC is claiming that that Ripple did wrong?
For sure. Yeah, absolutely. So they sold an asset to people that they could deduce what the intent was of why those people were buying that asset. And then they were the ones, the actual Ripple company, that were dictating the value of the actual asset itself. So again, these are all the claims that the SEC is making towards Ripple. I'm not saying any of these are true, but there is a legitimate argument for sure in the context of when they issued the token, they definitely sold it to, say, funds that have a very specific intent for why they buy assets. But then above and beyond that, what's interesting about the case is we didn't have any type of SEC clarity in regards to what tokens could potentially be securities. So they basically took the traditional securities analysis called the Howey test and layer it into an asset that had really never been evaluated before. And because there's a centralized company in this context, like Ripple, unlike in the Bitcoin context, then there's a party that they can identify. And if they can marry the expectation that a token holder has in regards to them making profits off of holding that token with the actions of the company, then that's how you get into securities territory. So there's a really famous case called the Howey test, where it's Howey case that led to the Howey test. And it was about a company that basically said, we are going to promise you a contractual right to profits generated by orange groves. And so they were basically saying, we're going to take your money via your investment. We're going to go develop these orange groves. And then when we sell the oranges, we're going to take a percentage of those proceeds and give it back to you. Well, from the investor standpoint, all you do is you give money to the company and then you wait for your return. So the more that a cryptocurrency project looks like something like that, in that all you do is you give over your money and then you wait for that company to dictate the value of that asset, that's where you should probably have more concern, conversely to other projects that are obviously a bit more decentralized. And what I mean by that is that when you see companies that, for example, are saying, hey, our token's about to be listed on these X exchanges, it's going to 100X in the next week or month or something along those lines, just know that those are all problematic things to carry out from a strategic standpoint for a company, because the SEC is going to look at that and factor in all of those aspects. With the contextualization that the industry is pretty diverse in the context of projects that exist, and as a result, the SEC and also state regulators only have so much bandwidth. And as a result, so they're pretty picky about who they're going to go after, like Ripple, for example. There's rumors around them going after Binance International as well. But, they're really looking at bigger fish in the context of companies that operate in the industry, which has its positives and negatives.
That leads me to a question, actually. Just because it's a little bit interesting to think about something like the SEC, a U.S. regulatory body, potentially being able to go after something like Binance, an international company. So could you speak just a little bit about, if they were to, what might that look like? Not necessarily looking to get into possible ramifications. That's a lot of speculation, of course, but would they just be attacking the Binance US side, or could they potentially have an impact worldwide on something as global as Binance?
For sure. Yeah, it's a great question. So, from a jurisdictional standpoint, they would most likely only be able to go after the branch or arm of Binance that is directly adhering to the US customer base. So, we call this a nexus, just connecting the actual company with the user base. So, for example, if you have a company and sitting in Estonia, if you sell all your assets to US individuals, you are under the SEC's purview. That's creating a nexus with the jurisdiction. So Binance, and for those of you who know its historical backdrop, has implemented what we call an island hopping strategy. Essentially, once a environment that they're in from a jurisdictional standpoint gets too hot from a regulatory oversight perspective, they move to another jurisdiction. They did this initially out of China and then moved to a couple different jurisdictions. And now they've basically siloed their business model into different jurisdictions. So we have Binance US, right? Now, it's interesting, Alex, because your question outright, the answer would be they can only go after the activity that they're providing for the US customers. Mm-hmm. However, Binance presents a unique situation where their products in the international context are quite different than obviously their products in the US. There's limited tokens that you can access in regards to a US-based account. There's also no margin trading. So the reason why I bring up margin trading is mostly because I think it's a really good kind of nuanced answer to this overarching question. Can they go after Binance International? And what we're experiencing, and I'm sure a lot of people already are aware of this, is that there's a thing called a foreign VPN. And individuals and entities have been able to set up foreign VPNs within the United States and basically said, hey, we're not here where we are physically located, we're somewhere else. And then they've opened Binance margin trading accounts, and then they margin trade. There are requirements on Binance International to prohibit the ability for somebody to actually be able to access their product, right? So even though someone can use a foreign VPN to open the account, there still needs to be some check system from a compliance perspective within Binance that would prevent this from happening, or at least try to mitigate the risk. And for anyone who knows out there, they haven't done anything. I mean, it's really easy to open an account if you're based in the United States and you use a foreign VPN. So I think that poses an issue whereby the SEC is going to use that as justification to go after them and basically say, you aren't offering this product, right, technically, but you're not putting in the proper compliance measures to ensure that people can't circumnavigate this limitation that you've put on the actual service. So I see that as a pretty forthcoming issue for sure.
That makes sense. Yeah, you're 100% right. I remember kind of back in the day when I was first getting into all this sort of stuff, I was starting to create some videos on the whole thing. And so I was going through and making accounts on as many exchanges as I could find just to create like kind of a super list. And at first I was not familiar with Binance. And so I just went to standardbinance.com. And of course, my standard operations at home anyway include using a VPN for everything. And it's like you said, it was incredibly simple. And then after making just a standard Binance.com account and getting approved and everything, which again, super easy, I then was digging more before I put out the videos and realized that I just did something I probably wasn't supposed to do. I had that exact thought. I was just like, wow, that was remarkably easy and streamlined for me to get on there. And of course, from a law enforcement perspective, ignorance is no excuse for breaking a law. And then on their part, of course, being willfully negligent or whatever,
right,
probably isn't the strongest defense.
Right, exactly. And I also think it bleeds into a larger point too, is that the technology itself, right, blockchain, it is immutable, right? It's unhackable in that context. It's the third-party providers that build their applications on it that are potentially problematic. I mean, I'll rewind all the way back to when I used Mt. Gox and when it got hacked. I remember, and we're still waiting around for our claims to be processed from the person controlling that in that context. So,
and for context, that was what, 2014?
Yeah. 2014.
Are you going to be a recipient of this August airdrop?
Yeah, actually.
Are you?
It's like, are
you going to dump on us?
To let everybody know, it's about 22% of what I lost on the exchange originally.
Wow.
So everyone who's getting their money back is getting around that percentage of what they had.
Is there like a vesting schedule and more is set to be coming out in the coming months?
Over time, yeah. There's like this whole reconciliation recovery process that they have going on in Japan. And and also it's funny because I represent a couple clients that had larger amounts than I did on there that got hacked. And they're also going to potentially benefit. But a few of them actually sold their claims to a company called Fortress. So Fortress has been going around over the last, I don't know,
interesting
7 or 8 years, just buying up the claims for 75% of what you would potentially be entitled to, because it's a guarantee immediately. And some people want that. And I have a couple clients that have held out. I have a couple clients that said, hey, yeah, I'll take it. No problem.
And that's based on current market value of Bitcoin, or how do they pay? How do they determine the price to pay for those claims?
The Fortress claim was interesting because they came in at first and started offering like 30% of the overall claim value. And then over time, they got all the way up to, I think, like 85% or something like that, because they were just
I didn't even know you could do that. It's kind of like buying student loan debt from different like loan providers, right?
Absolutely, 100%. Because up until about a year ago, we really had a lot of uncertainty around the payout process for how the reconciliation process was going on in Japan. They're pretty mystique in that context. And unless you filed a claim directly and had they sent you like a password and an account and everything like that, unless you had that, outside of that, they weren't releasing really any information. So it's some people, it made sense. And it's definitely it was a way to hedge their bets. And obviously, like, now I hope they're not kicking themselves, because you got to take gains, and it's not really gains in that context. But at least they recover.
There are so many examples of that in crypto. Like, I don't know about you guys, but my deepest fear, I fear missing out. I fear selling something that could go to $1 million 100 times more than I fear losing 100% of the money that I invest. You know what I mean?
Like,
that makes sense, right? Like if I buy something, like if I bought SafeMoon at 0.0, 8 zeros and then like a 1, right? And then it goes up to the SafeMoon run that it did on. And I sold too early or didn't buy, I would regret that far more than buying a ton of, whatever cryptocurrency and having it just crash 95%. I'm used to that. I love that. I live in that. You know what I mean? Like, that's just, I call it, just it's emotional training, I guess.
Mack is very familiar with this story of my biggest L, which puts me firmly in that category, and has forever scarred me in that exact scenario. So the first cryptocurrency I ever purchased was Ethereum, and everything is obviously not financial advice, but this certainly isn't, because the only thing I knew about it was the name. And the only thought in my head was like, man, that's a cool name. Buy. And granted, it was much cheaper at that point. I think it was about $89 to $91 or something like that per ETH. But at the same time, I only thought you could buy like a whole coin. So I got a few of them. And Ethereum Classic was also an option, and it was much cheaper. And of course, I didn't know anything about what I was doing. Got a ton of it, kept getting more and more and more and more of it. And if you look at the chart for ETH Classic, it's sort of one of these followed by that. I sold all of it right there. Like, I don't know, 2 days before that happened. And I haven't even brought myself to do the calculation, honest, of how much it would have been up there. Because right at that day, I was fancying myself like the crypto research guru. And I looked up all this stuff about ETH Classic, and I was like, oh, it was created for this. This is why it exists, and no one's doing anything with it, blah, blah, blah. Be much better to roll that into Ethereum. So I did that. And then I don't remember, what did it do? Like a 9 or a 10x or something insane over the next week. And I mean, I sold hundreds of ETH Classic right there. Learned 2 valuable lessons. Don't ever sell the whole bag. And
that's right.
Yeah, think about what actually is impactful in the space.
Right. We should get now, crypto investors, I feel like, have pre-traumatic stress syndrome. You know what I mean? Where they're right on the cusp, and they're like, okay, if you've been burned, like you have, and I've done it too. I think my classic story with that is I had Binance. I invested in Binance coin super early, right? And then everyone was hyping up Chainlink. And Chainlink is cool, on paper it has all the things that you would expect, but I sold Binance for Chainlink. I was like, Binance doesn't do anything, and it's an exchange. This is before they came out with Binance Smart Chain and became a whole operation, right? And so I sold it, I think at like $42 for Chainlink. And Chainlink, I think it was probably around like 10 or 15 in that area. And then Binance just shot up to like 600. And I was like, I truly, yeah. And then
sitting at a 5x gain from where you dropped
What's
it.
That?
Well, I said, and even now in the throes of this crash, Binance BNB is sitting at a 5x gain from where you dropped it. And Chainlink is less than sitting at 6 or 7.
Don't even,
Right. Well, if it makes you guys feel better, I don't think I would be on this podcast right now if I had just done nothing after my first Bitcoin purchase. My Mt. Gox Bitcoin purchase were $30 a Bitcoin. And, the thing is, like, over time, like, these are why the stories always get me, where people are like, oh my God, if I just bought it then, like, I would have now become like a multi 10, 20, 30 millionaire, like things like that. And I'm like, no chance would your life have just transpired where you didn't think about it or potentially consider taking gains. I remember when it went to $300 and I was like, holy crap, and went on like a vacation to Punta Cana, and it was amazing.
Wow.
I don't regret it, but also like I do regret it. And like, it's obviously benefited me over time, but like there's definitely those instances for sure. And then even so, as recently as like getting a bunch of Shiba, thinking nothing of it, selling for like a 20K profit, and then like 3 months later it would have been $1 million profit. I'm like, oh, okay, well, this is so ridiculous. Like,
ouch. That's the thing. There's two things to learn from that, right? One is, no matter how bad your story is, there's always somebody who has it worse. And I feel like the biggest crypto accounts, the biggest holders, have the biggest L's to their portfolio. Yeah. You know what I mean? Like, if you're a whale and you've got millions of dollars in crypto, you've probably lost 5 times that amount at least in opportunity taken. And then the second thing is that, this Mt. Gox thing could end up being, I think, a very massive blessing in disguise for a lot of people. Because like you said, Andrew, if you buy this stuff and you think, you write it off, oh shit, I got hacked, I'm never getting that back. And then they give it back to you in 8 years and it's worth 100x what it was. That's sweet. You know what I mean? You don't have to worry about, oh, I need to pay the bills, or, oh, I'm worried it's going to go down. You just hodl, and then time will do its thing. Mm-hmm. So I hope that happens for some people. You know what I mean?
Absolutely. No, I couldn't agree more. And I think the other thing too that we've seen in definitely the last couple of years now, the transformation is the ability to earn interest on your crypto. Mm-hmm. I mean, that wasn't around 3-4 years ago in the context of third-party providers actually in the United States allowing you to have that. And granted, there's been some backlash in a couple of different instances, specifically to BlockFi with the SEC, but at the same time, you think about the ability to stake or the ability to allow companies to loan against your assets. It's like, now you have I'm like envious of people that are coming into the space now because they're like, oh, I can access crypto. And I'm also able to hedge because I'm going to be making interest off of it if I'm properly managing it. And so like there's a lot of opportunity there where I see like, hey, you can, it's becoming kind of not necessarily a traditional asset in that context, but it expands beyond just simply having your ability to hold it, because now you're also making more crypto off of it if you want.
That's a super interesting area of discussion, I think, that I would love to get a little bit more of your perspective on. So couple points in particular. First, the interest appeal, totally get. The thing that initially got me to like put my weight into learning about this stuff was that idea that I added up one day how much my savings account had made in interest. And I was just, it hurt to look at the number. It was not an insignificant savings account. And I figured I was earning like 0.05% APY, which was unbelievable. And I had never really done that math before. Looked more into staking stuff. And of course, now, like you pointed out, there are some big issues with kind of the way that some platforms are running that sort of stuff. So I'm wondering if you could talk a little bit about like this kind of gets into more of the securities violations and stuff as well. But, we're in the NFT space. That's why we originally sought your counsel. NFT projects or crypto projects in general that are leaning into that advertisement, right? We can offer you 1,000% APY, staking, whatever you buy this token, all that sort of stuff. What are some things to be aware of when you're looking at something advertising like these earning platforms and high APYs and crazy yields and stuff?
Right. Yeah, absolutely. I mean, I think one of the larger theoretical points, which is kind of embedded in your question, is to know that returns are diminished over time. And if you're guaranteed something that you think is too good to be true, it's most likely untrue. I mean, I'll give like a very basic example and then I'll actually get into answering the question. Because I ran a mining company, a crypto mining company, like I did that. We just started building GPUs like 2012-ish and did that till like 2015, 2016. And we would build out these like super extensive Excel spreadsheets that would try to anticipate how much profitability we were going to derive from mining. And we were off every single time. It was almost impossible to track. And even today is still near impossible to track because there's so many contributing factors in the context of like cost of electricity, something so simplistic as like the miners over time, they're obviously the hash rate's going to increase. So I take that example and use that as kind of like a precursor to that. If everyone puts their assets into the same protocol, then obviously the people who are earlier are going to benefit greater from the people who come in subsequently, because the majority of especially DeFi protocols are structured as such in the context of returns. And so they're not always going to be able to pay out these kind of insane numbers over time, but for a snapshot, they might be able to. And so when companies or individuals are evaluating these projects, one of the issues that BlockFi ran into is that basically they were violating securities laws because they were handling the custodial component of crypto. So if you put your crypto assets into BlockFi, it was similar to like Coinbase or a centralized exchange. You needed permission to take those tokens off of the platform. When a company takes on that custodial role, their compliance requirements skyrocket comparatively to a company that doesn't take on that role. Let's say a non-custodial wallet. Say I was able to instead link my MetaMask wallet, and instead I was able to earn some type of interest on that type of asset. Like, again, we're getting a little bit substantive. So I want to highlight, just for everyone's clarification, is that there's a difference between putting crypto assets with a company that's loaning on the back end and then paying you a portion of the proceeds from the loans, versus obviously staking in the context of locking your tokens within a specific blockchain that has POS, just keeping those two things separate. Regardless, the third-party applications that exist in both contexts, the kind of beware components of the platforms are typically derived from, hey, we're going to give you this absurd amount of return over time. And by the way, we don't necessarily have control over your assets, because that is how you have Terra Luna or some type of, say, like, I think it was Wonderland or something along those lines. Like these kind of time, right? That's what it was. Whereby like they're trying to basically give you everything, and they can't, because the reality is, from an economic theory standpoint, they're not going to be able to continually generate the returns that they're promising, because obviously people are going to either take their assets out, or they're going to realize that they're not getting paid as much, and then they're going to go off and use some other platform. So when people try to marry this concept of, hey, we have a DeFi protocol that's going to pay you an insane amount, by the way, we don't have any custodial control over your assets, be super wary, because that means that, one, there's not going to be any recourse against the company, at least nothing in the short term, in terms of you being able to recover your funds if something goes wrong. Side note, we just submitted a proposal for the application for counsel for the Voyager bankruptcy situation. And then also thinking about the Celsius situation as well. It's like, you think about these products that are out there in the space, and they can be super problematic in the context of how they're actually implementing any type of compliance procedures. Because even though I'm identifying one that doesn't have a custodial component to it as kind of the highest risk, if you even look at the ones that do have the custodial component, one of the issues there is that they're definitely not FDIC insured. They're just going to file for bankruptcy if something goes wrong. And then you're going to have to sit around and wait for years to even potentially recover a small percentage of your tokens. Like I am waiting around for the Mt. Gox situation. So it is really one of those scenarios where you want to be super careful, especially around these DeFi products that are out there that claim to be able to provide this security, because the reality is that if anybody has this non-custodial component and they're promising high returns, they most likely have a vulnerability that they haven't addressed. And as a result, your assets are just vulnerable comparatively to other areas that you could potentially have more security.
That's so interesting. So you're kind of caught between a rock and a hard place then, right? If I am looking at a company and it's promising these great things, either it's decentralized and it's kind of akin to Terra Luna in the sense that if something goes wrong, A, there's no recourse, and B, it can spin off the rails. Now, I know that they did kind of a situation with their dollar pegged stablecoin. So not every DeFi protocol is going to have that. But if it's decentralized, then there's no recourse if something bad happens. And if it's centralized, then they're violating securities laws, basically, right?
Right, because the centralized one is they have a managerial component over assets. And so you're in investment advisor territory. There's the Investment Advisors Act of 1940 as well that applies. And so this is why BlockFi got dinged with $50 million to the SEC and $50 million to state agencies, is because they basically, and by the way, they knew what they were doing. They're pushing the boundaries, and they've raised, I think, up over $1 billion or something like that in series funding. So they were hedging for this for sure. But the idea behind it is you can't just go out and offer this type of managerial based investment product, because we were all just sitting around waiting for them to process their loans on the back end and then pay out their interest. I still have a BlockFi account that's gaining interest. So like they still do it. But again, what they're having to do now is they're going to, instead of offering your payouts in crypto, they're going to have a BlockFi investment product that basically you can invest into, similar to kind of like an ETF, whereby they consolidate all their loans and then pay that profit out back to individuals. But you're going to have to be qualified. So accreditation most likely is going to be the initial requirement, or some type of affiliation with an investment fund. So their user base is definitely going to be a bit constricted in the future for sure.
Wow. Yeah, I remember we asked you about that at one point too, because we were thinking of, we know some pretty solid traders, and we were trying to come up with a plan to bring in community members at a low cost to entry without having them have to be accredited investors. But yeah, it was the same thing. I think you said if they're non-accredited, then there's a limit of like 40 that we can do or something like that. Community members. And then, but even then, it still wouldn't be able to, it would have to be decentralized in a way, right? We wouldn't be able to hold it, or I can't remember exactly what the details were, but it was something along those lines. And we would have had to get a Series 6 and Series 7 and advisor and accreditation and all that stuff.
Right. Yeah. So it's actually 99. So most funds or managerial like entities like that are going to be capped at 99 for the investment product that they're offering. But yeah, no, it's a very real thing. And I think that the other context too is that people get rightfully misinformed because they see certain governmental agencies treating crypto like commodities. Yet if, for example, you manage commodities on behalf of somebody, in this context, you manage crypto, then you're running afoul of potential regulatory requirements. And so I think that's like, there's definitely some confusion out there, because I mean, I've represented clients before, the SEC, CFTC, FinCEN, and IRS, all in different contexts. And a lot of times it's around them offering some type of product or service into the space, and them not necessarily taking the proper like licensing requirement steps or the compliance requirement steps and things like that.
So you mentioned a couple different regulatory bodies right there. And I wanted to ask you two questions. One, we've seen recently a proposal come across the Senate floor that would move regulation authority to the CFTC from the SEC. So I was wondering if you had any opinion, or maybe you could shed a little bit of light for people on why does that matter? Is that a good thing? Would that be a bad thing? Because it's definitely being, paraded around at least the the Twitter space and everything like that as being exclusively good, and this would be the answer to all of our problems and that kind of stuff. Which I feel like, may or may not be a little misleading.
Yeah, it definitely is a little misleading. I mean, the context is that the authority that those two governmental agencies derive from are based on two different federal statutes. So the SEC gets their authority from the Securities Act, and then the CFTC gets their authority from the Commodity Futures Act. And so basically what that means is that they have different purposes and different reasons why they exist. One of the major differences is obviously that the CFTC is going to be going after more of commodity-based investment products in terms of their oversight and regulatory enforcement. So what that means is they'll go after the futures or the margin trading that are being offered on Binance, for example, or they'll try to regulate those types of investment products that are built on blockchain, but are a bit different in the context of obviously futures. And so one of the benefits that would come out of that shift is really the lack of clarity that the SEC has provided, but also the more adversarial nature that we know the SEC to be compared to the CFTC. So the CFTC definitely has an adversarial component. I don't want to say that by any stretch of the imagination. However, the SEC very much comes from a more stringent consumer protection perspective, meaning that they're all thinking about, okay, hey, in the securities context, how does this fit into the traditional regulatory environment that we have been granted our authority through? Mm-hmm. The problem with that, as we've seen, is that this is an entirely new asset class that does not fit the traditional mold for how we have designated things as securities for the longest time. And as a result, if it shifts over to the CFTC, we're going to have a different lens in the way that we have the ability to evaluate cryptocurrencies. And as a result, the onus or the emphasis from the CFTC's perspective will be much more towards the service provider perspective. So they'll be more business focused in that they'll be regulating, say, Binance and being able to offer the margin trading on Bitcoin futures, for example.
Gotcha.
But what they won't be doing is kind of plucking out individual tokens and being like, hey, this is more akin to a security because we're taking this traditional analysis and determining that it is. And so what it would really do, Alex, is it would provide more clarity because we would have more insight in regards to what the CFTC has done in the space comparatively to kind of this sporadic, hey, we're going to release this like 7-page clarification from the SEC after being involved in the industry for 6 years. And we're like, okay, well, we could probably use some more clarity, guys. So, yeah.
Okay, gotcha. Wow. That makes sense. I mean, yeah, I think a lot of the people that I hear, complaining like myself about the state of regulations in and around crypto is not that I don't want anyone to ever implement anything. It's just like, we have no clue what to do. We're out here trying really hard to, make sure that we're compliant where we need to be and where we can be and everything. But simple fact of the matter is that we often don't have an answer, even if we were, like, hey, give me the rule book I need to follow. It's nothing there. So the search for clarity definitely outweighs, I think, the what's the word I want here? Like the allergy that everyone seems to have to just regulation in general.
Right.
It's like the Constitution, it's we have the right to life, liberty, and the pursuit of happiness, but not actually happiness. We have the right to pursuit of clarity, but not actually clarity. It's the same for taxes too. It's like, you can try your best, but ISCAs are just going to be able to find things, that the law isn't going to tell you outright.
Right. So, well, I think also the larger context also for listeners out there that are curious about where this could go, because I've always said, hey, we need federal legislation. Like that is going to provide some clarity because our governmental agencies, our federal governmental agencies specifically, get a lot of their authority and their direction from legislation. And the fact that we haven't had any crypto legislation up until now is honestly just like super upsetting, because I see how productive the EU is in terms of working with the stakeholders in the industry to formulate standards and practices, things like that. And here we're really just lagging behind because our governmental agencies are much more adversarial in nature in terms of their oversight. So we're actually about to submit, and a lot of other organizations are submitting before August 8th, is notice and comment on the U.S. Department of Treasury or the U.S. Treasury's request for clarification around how to regulate digital assets. And so I think that this is going to be at least a small step in a long line of steps that are needed for us to get clarity so that we aren't in this direct conflict with governmental agencies. Because really those agencies should be creating regulation that's reactive to how the stakeholders are giving them feedback about how the industry is operating. That's why our federal government exists. Like, this is administrative law for anyone who doesn't know. That's the definition of it, is literally how do bureaucratic based governmental agencies dictate regulation and also make law in the context if the courts aren't, say, weighing in on an issue. And so the SEC and CFTC should be able to make regulatory clarity. And honestly, I sometimes do feel for Gary Gensler, who used to be the head of the CFTC and is now the head of this SEC, because people come in their interviews and they're like, well, are cryptocurrencies securities? And he's like, well, I can't think of anyone that I know that isn't potentially a security. And like, it's frustrating to hear. That sucks. I don't like that answer at all. But I also do understand that like he's kind of handcuffed because he can't say, oh, this token's not a security, right? Because once he does, people are going to hang him out to dry and basically say like, hey, you said this, like I'm going to use this. There's literally quotes from multiple SEC directors in the back and forth in the Ripple case. So Director Hinman, who's notorious for basically saying ETH wasn't a security, when like in all reality, at some point it could have been. But there's this issue with saying things as a representative of the agency that could be problematic. And so like we need that legislative clarity so that they can have a little bit more bandwidth.
Okay, Andrew, I want to bring it back to basics a little bit because you've said security a few times and we've kind of touched on it. But what is your basic, just chunk of somebody says, what is a security?
Yeah, for sure. Apple stock. Apple stock is a security. Any type of publicly traded stock is a security. Equity in a company, any type of debt within a company. If I'm an individual investor and I purchase X percentage of a company, say I get 10%, and now I'm a minority shareholder, what I own is a security. And just quickly running down how you determine whether something is a security, is there an investment of money, which is the first prong? 9 times out of 10, yes. Is it in a common enterprise? In the Apple context, obviously I'm investing in an entity, which is Apple. Do I have an expectation of profit? Why else am I buying Apple stock? And then the fourth one is called the efforts of others. Now, this is the most important one, especially in the crypto context, because if my expectation of profits, and this relates back to a comment I made earlier around sitting around and waiting for my money to get made by this company. If I'm sitting around with my Apple stock and I solely rely on Apple to generate an increase in value in Apple, then I'm in satisfying all four of these prongs, what we call the Howey test, which makes it a security. So when we talk about centralized entities in this industry issuing tokens, it's really important that those who don't necessarily want to run afoul of securities laws, side caveat, it's almost 100% impossible to fully mitigate any risk because of the lack of current regulatory clarity. But if somebody wants to try to attempt to do something akin to Ripple or any of the other cryptos that are out there, then they really need to implement sound strategies that try to diminish the connection between the user who's acquiring the token's expectation of profits with the actions that are carried out by the company. And I'm sure there are people listening who'll be like, well, then how do I even issue a token if I can't dictate like functionality or control or things like that? And again, it's every single analysis is case by case. But what's really important in the crypto context, and I'll use an example called the Munchie case, is the second time the SEC ever determined a token as a security. And basically what happened was the company said, hey, buy our token. We're going to go get it listed on exchanges. It's going to 100x. They said this through Twitter, their social media. They blasted their community. They did all these things. And they basically said, it was a restaurant review app token. So they launched they were going to launch a restaurant review app with the proceeds from the token. And then they were going to say, hey, we're going to go find all these restaurants and we're going to get them on. We're going to review them. It's going to be great. Well, that was all solely dictated by the company. And then also on top of that, they're creating this promotional aspect, inducing people to buy the token because it's going to go up based on their own efforts of the company. That's full on securities realm. So those out there who are considering issuing a token or are issuing a token, you want to be super careful about how you go about communicating to potential token purchasers, as well as what entities are the ones issuing the token. Because you'll look at some of the larger companies in the space that have gone out and created these larger corporate-based infrastructures that utilize foundations, and then even bleeding into DAOs a little bit, where you could try to offset the decision-making component to what the value of the token is, and therefore ostensibly diminish liability for the people who are operating the company. So what that means is that if you shift the decision-making of the value of the token to the community, then you're making a pretty solid argument that the token itself is not necessarily a security, because those people are manifesting their own destiny, for lack of a better term. They're not sitting around waiting for this company that issued the token to really dictate the value.
That's a good point.
I want to tie this to NFTs a little bit, since a lot of our audience are NFT holders, NFT fans, and stuff like that. So when you say token, you can obviously include an NFT at its core. An NFT is a token. Most people would associate it with the artwork, but really the thing in question is the token underneath it. So when you're talking about the expectation of profit, now at this point, most people would look at most NFTs and say that they're buying it so that when the floor goes up or whatever, they can flip it for a profit. So very clearly there is an expectation of profit.
Mm-hmm.
So the things that you want to be looking for that could set that apart a little bit. If I tie it to something like a Pokemon card, some people would buy a Pokemon card with the expectation of profit, right? Like, I'm going to collect this, I'm going to hold on to it, it's going to go up, which would make that fail a test. But you could also buy it for another reason. So is that something that can help offset some of that risk with an NFT, if there is an alternate utility, like another reason, like I'm trying to sell you this NFT so that you can use it in this game, or to acquire this, whatever, get access to this concert or something like that. Does that offset it, or does it not really negate the still expectation of profit that could be there? Or?
It definitely diminishes it for sure. So we call it the shadow prong, which is functionality. So the more functionality that you have on your platform, and especially in relation to NFTs or even tokens in general, and this is the argument around Ethereum too, and the Ether token itself, like it's actually use cases to be utilized on the platform. And I'll get into NFTs, and I'm just using Ethereum obviously because the 721 standard came around first. So in the context of what your intended purpose is, if that gets fleshed out in the factual determination of, say, like an administrative hearing with the SEC, then most likely, yes, you're going to be able to argue and probably win that there is a specific intent for why somebody's buying this in terms of its use case within a game. And that's why a lot of the play to earn games have, especially in the NFT context, not had a substantial amount of risk around securities in relation to their NFTs, because it's a really clear objective to come in and say, hey, okay, this is a NFT deck building game. I need like the higher power NFTs if I'm going to be able to strategize around which cards to use. And as a result, that's why I'm buying it. Now, granted, there's a monetary component, just like there's a monetary component to your Pokemon card example or Magic the Gathering or anything along those lines. So it's really about the lack of impact that the company has in the context of, yes, why they have that expectation of profit, and then also their ability to realize that expectation of profit. So which goes into this larger question around, there's a lot of companies out there that are like, hey, I'm going to generate a bunch of NFTs. What we're going to do is we're going to assign like a royalty right to one of the NFT or to the NFTs that if you sell it, then you're going to benefit from subsequent sales. Or we're going to have a liquidity pool where 2% of all NFT sale proceeds are going to go into that liquidity pool. And then the directors of the company are going to utilize that to increase the value of the overall platform or game or whatever it is. Like these additional economic incentives, buybacks are a really good example of this, are potentially problematic. And so it's one thing to say, hey, here's the functionality, here's the purpose, but it's also, you want to add on from a risk mitigation strategy perspective, not allowing, say, something so simplistic as like a royalty right or a liquidity pool right to come in and potentially push it back towards the securities realm. because you can have all the functionality you want. But at the end of the day, if I just put my tokens in a DeFi protocol and I'm generating revenue, and it turns out that I actually had to put my tokens in a wallet that's custodied by the company that provided that, making it a lot less DeFi, then that's problematic, right? In that context, it's kind of the same application with NFTs, because NFTs outright aren't typically considered not to be securities. And one of the reasons behind that is the lack of divisibility. So if I take one Bitcoin, right, I do 0.8 decimal points. I can do any amount. If the value of Bitcoin increases, completely unrelated to my obvious holding of a Bitcoin, then all other Bitcoin, right, increases in value. Well, NFTs, because they're singular, right, and they're not divisible. If, say, one Bored Ape increases in value, that doesn't mean that every other Bored Ape is going to increase in value. And that's a really important distinction in the context of this connection between the expectation of profits, functionality, and the efforts of the company. Because if you can argue that, no, this is actually subject to the fact that everyone wants to buy a Pokemon card because there's secondary markets that I had nothing to do with, then you're not going to necessarily be able to come in as a regulator and say, hey, you're culpable, you're liable, this is potentially a security, because it's so distanced from your control, especially in the secondary market context. So the last point I'll make is the NFT marketplace, right? Like, look at OpenSea, for example. Like, OpenSea isn't facilitating securities transactions in the context of taking a transaction fee out of the sales. And that is mostly because the assets that are being traded are in of themselves not securities. If OpenSea did that same exact thing with crypto, they would have problems. Like,
wow.
you just might.
That's really interesting. Yeah, because, I think on your first 2 points about the securities, is there a money aspect? And obviously there are, if anyone's selling NFTs, right? People are going to buy in. And that could kind of be construed as ownership in the company. But I think the biggest thing that you helped me understand is the part about the promise. If you promise something before you sell it, like if you promise royalties, right, then that would be a violation because it's expectation of profit. So if you say everyone gets an NFT and you're guaranteed to get 70% royalties going forward, then that is a straight up red flag, can't do, because that is a security, right?
Right. Yep. Yeah, exactly.
So, okay. And then the ability to realize the profit of the company. So that's also kind of like, how much control does the company have, or custodianship in holding your assets, manipulating the price, doing whatever they need to do, whether that's buybacks or anything like that. So, and if it is, then that just means it needs to be registered with the SEC.
So we're sought under an exemption, because there's exemptions to the Securities Act that people can obviously adhere to. So there's Regulation D, Regulation A, Regulation CF, crowdfunding, stuff like that. There's all these different iterations that allow for, say, being able to sell an asset that you don't necessarily think is Apple stock. So that is always an option. Granted, every single one of those is going to have a more limited community than if you go out and just sell to the general public via the crypto community. So
let me ask you this. Oh, sorry, go ahead.
No, that's it. It's identifying this jurisdictional disconnect between the technology, which is very borderless, and the regulatory regimes that we have across the world.
So that's what I wanted to ask you. If I'm French and I want to create my own NFT project, why should I care about what the regulatory landscape looks like in the United States of America? Can I just, if I don't know what the SEC of France or EU is, but if that's not an issue to promise royalties, why should I care about making an NFT project over in France and just say, screw it, I don't care what America's doing over there?
Yeah, if you're not selling NFTs to US individuals, then you're not creating that nexus, and you should have no concern about the SEC. So again, like, none of this is legal advice, but at the same time, like, I don't practice in France, so no one's going to hold me to that. But no, seriously, there are, we have European clients for sure that when they blacklist a jurisdiction, like, the whole point of that is to not have to worry about the compliance requirements within that jurisdiction.
But you can't do that for NFTs if you're just selling it on the internet, right? Unless you do KYC.
Right. Yeah, exactly. So there's a conundrum in of itself. The other component too, but you can scrape IP addresses. So there are service providers out there. So like I represent a few different of the larger like play to earn games that started way back when and have now become massive. And they scrape for IP addresses for sure, because they're looking for IP addresses that are on sanctions lists, which basically means like the US government and other governments collaborate and release every year lists that basically say like, hey, here is the address for, I don't know, like ISIS. Don't transact with this IP address. And if you do, it's very problematic. And so there are definitely risk mitigation steps that are precursors to KYC, but also at the same time, you highlight a massive conundrum, because it's like risk versus reward at its finest. Yeah. Do you KYC? Do you verify identities? Or do you do what the majority of projects do and go out and just hope that you don't get dinged from a governmental perspective because they don't have the bandwidth to go after everybody?
And then
definitely seems like
if I wanted to get around that, I could just use a VPN, right?
yeah,
you
sure.
Can't say that, but everyone watching knows. I mean, right? We already talked about it, so the cat's out of the bag. So that I'm just saying, like, not as a way to kind of get around that as an investor, but from a company standpoint, like they could be facing the same thing that Binance would be facing then ultimately, right? If they became a big enough deal, right, then our regulators could go after them. And then if that happens, what would the SEC do if they say, you know, okay, we determined that 40% of your NFTs were given to, you know, US investors? Does that mean that they just confiscate 40% of the NFTs, or, you know, what would happen there?
So in that context, well, I guess the assumption is that the NFTs are problematic in some context, right? They have a royalty right. So there they would carry out an administrative proceeding, determine what the actual violations were, and then most likely levy a fine against the company. So, but they would only be able to levy the fine based off of the amount that was sold to the US individuals, because I want to be clear about that. So for those of you listening who remember Block One, which is basically the company behind EOS, raised about $4 billion in their ICO, and they paid the SEC $40 million, which is a pretty good price tag to be able to raise $4 billion.
Yeah.
But the contextualization was that they were only being fined based off of the sales to US individuals, because the SEC can't come in and say, you sold $80 million worth of tokens to Asian countries, we're going to fine you for that. It's like, okay, well, they really need to think about what their jurisdictional authority is, because if you go off and do that and you don't ever sell to the United States, the SEC has no jurisdiction. So like, what are they going to do?
Got it. Wow.
Sure.
And then that was just $40 million based off of the price that they earned from American investors at that time? Or did they just do it at current value? Or do you have any idea for where they come up with that number? I know it's based on US consumers, but price is based on them.
Definitely point the sale for sure from a proceedings perspective. Like I would say that they're not to say that they couldn't do this, but the SEC would be pretty hard pressed to come in and say like, hey, now EOS is worth like $300, and as a result, we're going to fine you like this much based off of that. And I think that's the other component too, is that especially for people who are potentially having this happen to them, which again, very, very small pool comparatively to the larger industry. But for those who it does happen to, the best thing to do is throw your hands up and just cooperate, because your fine's going to be less if you do that. We know that because we've had people go through that process and do that. And the SEC has identified their willingness to cooperate as like a factor that they put into it. So it's definitely an important component, even though like there are definitely projects that I represent as well as projects out there that are like, well, we allocated a war chest and we're just going to fight them if they ever come at us. So,
wow.
So I know we're coming up on the hour here, and I want to be cognizant of your time, but I do have one more question. But first, I just wanted to point out, or say rather, Mac, do you remember when we first talked to Andrew, like what that day looked like? Because I've been thinking about this story for the entire time that we're talking here, just hearing you kind of go through everything and remembering, you know, why it is that we initially pursued this working relationship more, because I was personally very impressed with just your acumen, not only on the legal side, but just how crypto literate you were, how long you had been in the space. I mean, Mt. Gox is no small thing. And
I know
so
you're going
the day that we met with Andrew, we had one more meeting immediately before the call with Andrew. And I believe that was it was a potential CPA, right?
Yeah.
And
not Lorenzo. We've had Lorenzo on the podcast. He was the one we chose because he was fantastic, but we had to weed through a few to get to him.
Yeah. It was not. I've been through some meetings in my day, and this was one of the most awkward. I think Mac texted me like 5 minutes, not even into the first meeting. He was just like, "Dude, no, how do we get out of this?" And we were like asking all these. We had like a list of questions and all this stuff, and the only thing this dude could tell us was just like, "Yeah, dude, you guys just got to keep track of it. Just keep track of the numbers. That's it." And I was like, "Well, yeah." But
got that.
There's more, right? Like, taxes, how does this all work? And he's just like, no, man, really at the end of the day, it's all just about keeping track of it. And, I don't think I paid attention to anything in the meeting. And then right after that, we rolled into meeting Andrew for the first time. And both of us, number one rule, right? Follow a dud. So you were just like, immediately we were just like, wow, okay, this is a little bit different type of meeting than the one we were just at. So right. I think it's pretty obvious from even just listening to you talk through all of these kinds of things. I have yet, I think, to ask you anything that you ever were just like, yeah, you know what, I'm going to have to read into that more, or, give us some kind of bullshit answer or something. Lots of examples, from your experience in the space that you can tie into the questions that we're asking. And I think that's it's super valuable. It's been very beneficial. I know I've personally learned a ton from listening to you and kicking questions to you. And it's actually been almost an advertising point in our community that, the first person that we really sought counsel from was a lawyer who knows a thing or two about blockchain and crypto and NFTs and actually has real answers and all this stuff. And I'm remembering now one of the first conferences Mac and I went to, I was fortunate enough to speak to the CLO from Exodus. And I just asked if she had any pro tips kind of on her way out the door. And she's like, the only thing you need to know if you're starting a project or a company or anything in this space is get a lawyer. I was like, all right, cool, done, deal.
Easy enough.
And you've helped us a lot too with not just advice, but planning and documentation and contract writing and, things to just protect us going forward. So yeah, to echo what Alex said, we very much appreciate it and we highly recommend your services. So
well, thanks, guys. I really appreciate that. I will also say, because I've been in your position as well. Like when I did the mining company, I remember trying to find legal insight, and I was like literally in law school writing about kind of the theory around like crypto, and the term blockchain didn't even exist yet. But the painstaking process of being like, man, I got to figure out these legal issues, and not having like competent legal counsel to go after. That's really what ultimately led me to where I am today. So it is very much a painstaking process that a lot of people experience in the industry. So I definitely echo. One, I appreciate the sentiment, but also on top of that, there's a lot of lawyers that are, hey, I've been a securities attorney for 35 years. That for me, I'm like, well, you got to understand the technology as well, because then you're not going to be able to kind of marry that and really come to the table and be able to talk about it.
It's so comforting as an investor or a project, owner to talk to somebody who gets it, who's in the culture, who understands, and you've been in crypto longer than both of us, which, as time goes on, those people are harder and harder to find. But and when did you start? When did you go? I don't know if you out of law school, you went right into crypto law, or, how long has the crypto law, bull blockchain law been going?
Yeah. So I started at a firm and went to one of the partners probably in the first month that I was there, because I was going to we were running a crypto meetup, was doing the mining, had already invested in Bitcoin and then done ETH when that came around, and then started doing some of the smaller ICOs as well. And so all of that led to, hey, I went to the partner. I was like, hey, I think there's this industry that's about to really come into fruition from a legal standpoint. And I've been writing about it, by the way. And they were like, yeah, whatever. You want to take on clients, you can. And I was like, all right. And then 6 months later, I was like, all right, I'm going to leave because you guys started doing something traditional. So yeah, wow. So it was kind of that transition, really. I can tell you about too many stories around sitting there trying to get into the BAT ICO, the Brave browser ICO, and literally the blockchain freezing, and then being 4 hashes up, and I'm like, whoa, what happened? And 5 people got all the tokens. And I was like, what? Like sitting at the law firm that I was working at. Anyways. Wow. Yeah, but then it just kind of rolled into that. And I've been fortunate enough to also teach now a blockchain and crypto law course at the law school that I went to. I've been doing that now for over a year. So it's the whole industry is snowballing, and it's great to see over time for sure. I'm super excited to see what this next phase is like.
That's great. Yeah, keep fighting the good fight. We're all with you. Some regulatory clarity would be great, and it's it's your knowledge, though cherished, would be better dispersed. I think throughout the masses. So keep up the good work, man.
I mean, 100% right. Like obviously we're all rooting for some clarity at some point, but I will say that I think what we've done with your help is proof that if you actually give a shit and you try and you put some effort into learning and finding someone like yourself to talk to, you can navigate the space. It's possible to create a project and not just blatantly break the law at the same time. And I wanted to go into one final question that I had, and I'm not sure maybe if we want to move this up earlier into the episode or not. It's something that I had written down that I just completely spaced on. But whenever we talk about the importance of talking to somebody like you, if you're interested in creating a project, most people would agree and just be like, yeah, no, that makes sense. You should do that. The only pushback I get about why that doesn't matter or why it's not like a pertinent use of funding or why I should care about talking to a lawyer beforehand is that there's basically a safety in numbers perception of these sketchy projects, in that we've seen the speed at which US regulatory bodies are moving. Like we're still dealing with Ripple, and that's been in the courts for years. There's the case out of New Jersey with that couple and their staking interests who are, I believe, suing the IRS. Mm-hmm. And I'm, very curious to hear more about that. And I was going to ask you about your opinion on that, but I don't want to. I'm sure we could spend all day on this.
Yeah.
So, is there any validity to that idea, given the speed at which these regulatory bodies move? Should you, because personally, I'm not super comforted by the idea that, well, they can't get all of us because, taking any one down just kind of could set precedent for all the other ones that just threw caution to the wind and kind of went for it there. Or I guess, you don't know, maybe you're going to be that one, and I really didn't want to take the chance. It ultimately wasn't worth it considering what we're trying to build and how long we want to be here for. Right. Didn't know if you had any opinions on that kind of safety in numbers mentality.
Yeah. Absolutely. I mean, I think that rock can only go as far as somebody can throw it. And I think what that really means for me is I envision a recently hired state securities regulator who's just sitting around being like, all right, how do I make a name for myself? Let me look into a couple projects that are existing in my state, and boom, like they're all crypto focused. And now I'm going to go after these ones. And there was actually a pretty big sweep back in, I think, like 2019 or 2018, whereby state regulators filed a absurd amount across the board, basically subpoenas for information for a massive amount of crypto companies. And so while the federal perception for sure is, hey, they're only going after a very select few, the other issue that people face is that at the state level, every single state has its own version of the SEC, and they're going to be very specific around their state residents and be more protective even. So I think that brings in an additional issue that basically champions this general notion that you want to protect your personal liability as much as possible. And so a legal entity, legal documentation, proper contracting, all of those things, they're not just going to mitigate risk in the private context, they're also going to mitigate your regulatory risk, because I think that especially as we get even regulatory clarity over time, that doesn't necessarily mean that the adversarial state agencies and federal agencies are going to go away. And I think that they're just getting caught up more and more on what's actually going on in the industry. And as a result, I mean, you look at Ripple as a perfect case. Ripple was around for how many years before the SEC even went after them? Nobody's immune, one. And then two, I think that those cases on a smaller scale are just going to increase over time in terms of their volume. And so I think that's a equally diminishing return as 1,000% X and the DeFi protocol.
Well said. So there you have it, folks. The finest, not legal advice, but the finest legal counsel. What do we call it? The finest just education that you didn't know you needed. What'd you say?
Commentary.
Yeah, we'll call it that. So, all right. Well, we want to thank you so much for your time. Is there anything that you'd like to send out to our listeners as a final message? Anything you're passionate about? Where can people find you? What do you want to say?
For sure. Yeah. I mean, just Google my name, my website will come up. Anyone can reach out. I'm always happy to share additional information. I definitely think because it's an NFT specific community, like I was fortunate enough to get a CryptoPunk and like I thought that they were fun and blah, blah, and all that stuff. And like I played some of the games. And I think that while like the mainstream news, like it likes to kind of crap on this industry, has crapped on the NFT industry pretty heavily as of recent. But we all know, for those of us who have been in here for a long period of time, that there's a massive amount of application. There's a massive amount of development that's going on behind the scenes. And that area of the industry is just going to expand exponentially, especially over the next 5 years. And so I have a lot of confidence that it's going to just completely blow our minds in the context of its application and where it's going to be in the future, even though we've seen kind of a downturn, because these corrections are always helpful for this industry. And those who hold on and grid through it are going to definitely benefit from it.
Well said. All right. Yeah, I like that. I like that ending too. If anyone wants to reach out, they can just Google my name. I gotta see if that works for me. That's a baller move. But Alex, did you have anything else?
I just wanted to say thank you, Andrew, for taking the time out of your day to be here with us and do this episode. I look forward to any time we get to talk to you, because I always learn something. I can anticipate that the response to this particular episode could easily be questions. And so I would love for you to come back at some point. I look forward to compiling a list of things and concerns that people in our community may have that they may want to get your input on. It'd be really great to do a part 2. I've got at least 100 more questions I could ask you.
Right.
So thank you for your time. And I'm very excited to continue our working relationship in the space. And it's really cool to share the space with you. So thanks for being here.
Absolutely. Yeah, my pleasure. And always happy. Like, you guys let me know. I'll show up.
All right. Sounds good. Thank you, Andrew. Thank you to my co-host, Alex. Until next time, Rising Up by Faceless Labs.
Thanks so much for joining us on this episode of Rising Up. Hey, before you go, I've got a quick favor. Would you please take a second to leave us a rating and a comment or quick review? Aside from listening, it's the most important thing you can do to help our show, and we really appreciate it. If you want more from our team, be sure to follow us on Twitter at @TheFacelessMany. That's where you'll find the link to our Discord server and all the latest updates. If you'd like to be on our show, if you have questions for our team, or if you're interested in becoming a sponsor, send us an email to hello, that's HALLO, @facelesscrypto.com, or get in touch through the contact form at our website. Thanks again for listening to the official podcast of the Financial Revolution. Until next time, rise up.